Hello, alaikum salam. Do you hear me?
Yes, how are you, sir?
I'm okay. Thank you. How are you?
I'm also great. Alhamdulillah, thank you. Okay, sir, please to start the class.
Okay, thank you very much. Welcome everyone to this class. Actually, I came today just as guest lecture because I think your lecture, Dr. Wahdi, is busy today, or I don't know, he is sick. So, according to information I got today, I think I have to switch on my camera, or it is okay as long as you hear me. Okay, I think this is this you are in semester 6, and actually maybe we didn't have chance to meet before. Usually I'm teaching in IBIF since maybe 4 years, and I will be happy today to listen to you, as I got information from Miss Titania. She told me you will do your presentation today. So I think there is not much to talk about. About the lecture or presentation, I think Miss Titania, you will, there is need to present this, I don't know, chapter 10 for today, or we just listen from a student.
We just listen from student first, sir. After this, we have some forum like question and answer.
Okay, so student today will present the same chapter, or do you have another presentations?
They have their own presentation or slide.
Okay, about different subjects?
Same subject, sir.
Okay, okay, great. So how many students will present today?
I think 3, right?
3 students. Okay, 3 students. Every student, how much time? 15 minutes, 20?
I think depend on this group, sir.
Okay, so there are groups.
Yes.
Okay, good. Okay, I don't have anything else to say, but maybe if you start your presentation, I will listen to you, and if there is something you want to ask, also we will have discussion after this class. Maybe you start with first group. You can share your screen, I think.
Okay, please for group 5.
Assalamualaikum and good morning to everyone. We are group 5 and we will discuss about chapter 10, getting financial or funding. Next page.
Hello, good morning. My name is Fahan Aidil.
Hello, good morning. My name is Nur Hazira.
And my name is Ahmad Rabani Hakimi.
Okay, sorry to disturb you, but as I see, this is maybe our friends from Malaysia exchange semester.
Yeah.
Okay, great. Okay, continue.
So good morning to today. So I'm going to present about financing and funding. So financing is crucial for entrepreneur success as it provides the necessary capital to start and grow a business. So without enough financing, it can be difficult or even impossible for entrepreneurs to turn out their idea. So here's some reasons why financing is important for entrepreneurial success. Firstly is for starting a business. So entrepreneurs need financing to cover their initial costs of starting a business, such as renting an office space or purchasing equipment like computers, furniture, and hiring employees. So second is for business growth. As a business growth, entrepreneurs need additional financing to expand operation, hire more employees, develop new products, and enter new markets. So this is because the business has grown bigger and they target different geographic regions, demographic, and also segmentation in the market within their industry. So thirdly is attracting investors. So for attracting investors are more likely to invest to a business that have a solid financial finance. So to effectively and attract investor who can provide additional capital and expertise, because investor also want benefit from the business, of course. So if the business have no solid financial foundation, so investor also doesn't want to invest because they will gain loss instead of profit. So fourth is managing cash flow. So cash flow is critical for success of any business, and entrepreneurs need financing to manage it effectively. So in this include covering expense during periods of low revenue or investing in new opportunity that will generate future revenue. So next slide. So why most new venture need financing and funding? Firstly is for cash flow management. So in the early stage of business development, revenue may not be enough to cover ongoing expenses like salaries, rent, and utilities. So by raising funds from a lease helps to ensure the business have enough cash to operate and grow, while it works to establish a sustainable revenue stream. So next is initial investment. So starting a new business requires significant upfront capital to cover expenses such as research or any development, legal fees, any thing that include of to do new business. So they need to have really little bit money to start their business, so that entrepreneurs often do not have a fund so to cover their costs on their own. So which is why they seek an internal financing. So thirdly is sorry, marketing and sales effort. So for a business to succeed, it needs to generate awareness and interest in its product and service. This also requires a marketing budget for advertisement campaign, commercial materials, or any sales effort. So raising funds allow entrepreneurs to invest their marketing strategy that can help them reach their target audience and build a customer base. So next slide. So fourth is product and development market research. So to create a competitive product and service, entrepreneur needs to invest in their research, development and testing. So this process can be time consuming and also expensive, because it requiring a significant amount of capital to support it. So next is scaling the business. So as the business grows more and more, so it need more operation and hire more employees and invest many technology and equipment so that the business can run smoothly. So also raising a fund is early stage can help entrepreneur finance to these expenses effort so that they can run their business smoothly. So the last one is emergency saving, so that if you start a new business, of course, starting a new business can be risky and many challenges. So if anything happen to your business, so that the money that you save can support you, can can support your business to run. Next. So that's a source of personal financing that, but this is the three common that always use for personal financing. So firstly is personal saving. Of course, this is refer to an entrepreneur on money that is saved by the entrepreneur itself. So the personal money are often the first source by financing for a new business, but and it can be used to cover initial startup costs such as purchasing equipment, renting office space, or hiring employees. So personal saving also can help an entrepreneur secure additional funding from other sources as it demonstrates their commitment to the business. So next is personal loan. Personal entrepreneur can also obtain a personal loan from bank or any financial institution. So personal loan are meaning that the borrower is not required to put up collateral such as house or car. So you can borrow the money from any institution without put up collateral. So however, personal loan comes with higher interest rate, of course, right? When you borrow money from a bank, and it has interest rate. So the work credit also can, the borrower credit score and income will be taken to consideration when determining elimination. So the borrower credit score and income will be taken so that bank will know that if you can pay the money back or not. So third is family members and friends. So family and friends can serve a valuable resource of financial support in various ways. So firstly is they may provide direct financing assistance by lending money or make a loan from family. So this can be particularly helpful during time of financial hardship when you start a business. So family can help you. Additionally, family also can offer guidance and share their expertise, or also help the entrepreneur to do financial decision and investment. So moreover, family and friends can offer support and encouragement, and also boost confidence and motivation for the entrepreneur to pursue their goals. So that's all from me. Thank you.
Next, we will go to preparing to raise debt or equity financing. First, we will determine precisely how much money is needed. Second, we will determine the most appropriate type of type of financing or funding. Then we will develop a strategy for engaging potential investors or bankers. Next, there are two common alternatives. The first is equity funding, which means exchanging partial ownership in a firm, usually in the form of stock for funding. For example, I have a company that have potential to grow big. So let's say that I need 500,000 to raise for the company. I need 500,000 ringgit fund. So I know an investor who can help me with that. So I ask him that I want 500,000, and I will give him 10% of my share from the company, so that he can invest in my company. Basically, that is all. And next is debt financing, which is getting a loan from a bank, but you can go to other association as long as it is legal. Next. Next is sources of equity funding. There are three, which is business angels, venture capital, and initial public offering. Next. For business angels, they are individuals who invest their personal capital directly in startups. They are 50 years old, has high income and wealth, is well educated, has succeeded as an entrepreneur, and invest in companies that are in the region where he or she lives. Many angels are motivated by more than financial returns. They enjoy the process of mentoring new startups. Most angel investors remain fairly anonymous and are matched up with entrepreneurs via referral. So, for example, in Malaysia, we have an association for business angel, which is Malaysian Business Angels Network. For this association, there are two membership, which is angel membership and also corporate membership. For angel membership, either a high net worth individual, the well or net personal asset of RM 3 million and above or its equivalent in foreign currency, or a high income earner, gross total annual income of not less than 180,000 ringgit. The preceding months, 12 months, or RM 250,000 ringgit, jointly with one spouse. For corporate membership, because these data they're not shared about corporate, so I cannot explain because I'm not doing a research about that. Sorry. Next is venture capital. Venture capital is money that is invested by venture capital firms in startups and small business with exceptional growth potential. The distinct difference between angel investors and venture capital firm is that angel tends to invest earlier in the life of a company, whereas majority of venture capital money goes to follow-on funding for businesses that were already. Venture capital firms are limited partnership of money managers who raise money in funds to invest in startups and growing firms. The investor who invest in venture capital funds are called limited partners. The venture capitalists are called general partners. An advantage to obtaining this funding is that venture capitalists are extremely well connected in the business world and can offer a firm considerable assistance beyond funding. Next. For example of company that have been received investment from venture capital, this is a Grab company, which is e-hailing company and also food delivery company. As you can see in the second picture, they are the investor, they are the list of investor, and also if you see at the February 2020 and February 2021, there is a late VC, which means that they are the venture capital that invest in their company. Also in Malaysia, to be individual venture capital, the minimum amount that is individual investor can invest into a venture capital fund is about RM 250,000. However, some venture capitals put in higher at RM 500,000 ringgit and other lower at RM 100,000 ringgit. Next is initial public offering. An initial public offering, IPO, is a company first sales of stock to the public. When a company goes public, its stock is traded on one of the major stock exchange. An IPO is an important milestone for a firm. Typically, a firm is not able to go public until it has demonstrated that it is viable and has bright future. So, for initial public offering, basically we will go, normally in Malaysia, we will go to Bursa Saham to get to know which company is already listed. I need to explain about for venture capital and business angel. That time the company is still private company, but when you go to initial public offering, you already open the company to the public. But it is different because you still have like people with the share and also people with the stock. For public company, you will have to provide them with your like financial statement every year or every terms to show that how good your company to be able to receive more investment from them. For initial public offering, you need to what you have several tests that for this time I will explain two tests. The first is profit test. Uninterrupted profit of 3 to 5 financial years based on audited financial statement. Aggregate after tax profit of at least RM 20 million and after tax profit for the most recent financial year of at least RM 6 million. The applicant has been operating the same core business over the profit track record. Then the second one is the market capitalist test. Total market capitalization of at least RM 500 million upon listing. Core business generate operating revenue for at least one full financial year before submission. Basically, if you want your company to be listed, you must go through vigorous screening process by submitting complex documentation to the Security Commission of Malaysia through the issuing bank. Next. There are reasons that motivate firms to go public. First, is a way to raise equity capital to fund current and future operations. Second, raise a firm public profile, making it easier to attract high quality customer and business partners. The third one is a
Excuse me, Mr.
provide a mid company to
Mr.
recoup their
Ahmed.
investment, and lastly create a form of currency that can be used to grow the company via acquisition. That's all from me.
It is okay.
Yeah.
Maybe I didn't hear your voice well. Maybe there is problem in connection. Do you hear him? Other student, please. Do you hear him well?
If I'm sorry because if you not hear well because right now my internet connection is not good because my house is rain.
Oh, it is okay. No problem. I hope other students. Do you hear him well? Miss Titania, do you hear him? Okay, continue. Okay, no problem. At least we hear you now. Okay.
Okay, hello everyone. Next is my part, which is a source of debt financing. What is debt financing? Debt financing is borrowing money from external sources to raise capital. The borrower agrees to repay the borrowed amount along with interest over a specific period. Common forms of debts, including bank loans, bonds, and mortgage. It allows businesses and individuals to fund activities like expansions, asset purchase, and project funding. However, debt financing carries financial obligation and requires regular payment, impacting cash flow and financial stability. So we have two, which the first source is commercial banks and the second is SBA guarantee loans. So what is debt financing? So let me give you an relatable example for you understand further about debt financing. So let's say a small business wants to expand its operations by opening a new location, and then they don't have enough funds to cover cost of constructions, equipment, and inventory. And then to finance financing to obtain the capital they need for expansion. They will repay the loan amount along with interest in regular installment over a specific period. The debt financing allows them to pursue their growth plan without requiring immediate upfront cash. So the next one is commercial bank. So what is commercial bank? Commercial bank is like we have seen commonly banks, IMB, Public Bank Berhad, or HB Bank, Hong Leong Bank. So a commercial bank is a financial institution that provides various banking services. They accept deposits, offer loans and credit, facilitates payments, manage investments, handles foreign exchange, and provide other financial services. So commercial banks are regulated and plays a crucial role in the economy. So commercial bank also serve as intermediary between depositors, those who deposit their money in the bank, and borrowers, those who seek loans and credit. Commercial banks are regulated by central bank and other financial regulatory authorities to ensure stability, liquidity, and compliance with applicable laws and regulation. And they also play a vital role in the company and in the economy by providing financial services, facilitating economic transaction, and supporting economic growth and development. We have 5 key, which is the first one is deposit accounts. They accept deposits such as saving, checking, and CD accounts that can earn interest, and then loans and credit. They provide loans and credit, including personal loans, mortgage, auto loans, business loans, and credit cards. And then payment services. They enable transaction and payment through card, EFT, check processing, and online banking. So next is investment and wealth management. They provide investment service such as brokerage, mutual funds, retirement accounts, and wealth management for high net worth individuals. So next, the last one is foreign exchange and trade service. Bank facilitate foreign exchange, wire transfer, trade finances, and other international trade services. So next, we go to the second source, which is SBA guaranteed loans. What is SBA guaranteed loans? SBA guaranteed loans are loans provided by financial institutions such as banks and credit unions that are backed up by the US. So the Small Business Administration does not directly lend money to the businesses, but it guarantees a portion of the loan made by a lender, and this guarantee reduces the risk for the lender, encouraging them to provide loans to the small businesses that may not qualify for their traditional funding. So I have researched lots of similar organizations like SBA in Malaysia. However, I only took 2. So the first one is SME Bank. SME Bank is a financial institution in Malaysia that dedicated to providing financing solution to SME. So they provide various loans programs tailored to meet the specific needs of different types of businesses. Next is Bumiputra Entrepreneur Startup Scheme, SUPER. This scheme specifically targeted at Bumiputra entrepreneur, ethnic Malay, and other indigenous groups provides financing, support for startup, and existing businesses owned by Bumiputra entrepreneurs. So let's understand further about SBA with the relatable examples. So imagine you want to start a business bakery, but you don't have enough funds to cover all the startup costs. So you approach a bank to apply for a loan, and then they hesitate to lend you the full amount because you are a new business without a long track of record and significant collateral. So the bank is approved SBA lender and suggests you to apply for SBA guaranteed loans. With SBA guaranteed loan, the bank's risk is reduced and making them more willing to provide you with the loan. So you complete the necessary paperwork and meet the SBA eligibility criteria, and the bank reviews your application, assess your credit worthiness, and determines that they can lend you. So in that previous scenario, the bank provide you with a loan of $100,000 and the SBA guarantee a portion of the loan, let's say 75% to the bank, and the remaining 25% is the bank's own exposure. If for some reason you are unable to pay the loan, the bank faces a loss, but SBA steps in and reimburse the bank for the guaranteed loan, guarantee portion of the loan. So in that example, you can default in the loan and SBA will reimburse the 70%, aka $75,000 and covering the guarantee portion. And then SBA guarantee to give the confidence to provide you with the loan as they have some protection against potential loan. And it's important to note that while SBA guarantee a portion of the loan and helps you reduce the lender's rates, however, you as the borrower are still responsible to pay up the full amount the full amount of the loan to the bank. So next is other source of debt financing is the first one, which is online lenders. Online lenders are financial institutions that operate primarily through online platform, and they offer a simplified and streamlined borrowing process compared to traditional bank. So there are a few key points about online lenders. The first key point is online presence. Online lenders operate through websites or mobile applications, providing a convenient, accessible platform to borrowers to apply for the loan. And then next is quick application process. Applying for a loan with an online lender typically involves filling out an online application form. And then this process is usually faster compared to traditional ones. So the next one is digital documentation. Online lenders often rely on digital documentation and electric verification to gather necessary information and assess the creditworthiness of borrowers. So this eliminates the need for physical paperwork and allows for faster loan processing. Next is flexible loan products. Offer a range of loan products, including term loans, lines of credit, invoice financing, and merchant cash advances. So businesses can choose the loan type that best suit their needs. Next is competitive rates. So they often provide competitive interest and rate and terms. So they operate with lower overhead costs compared to the traditional brick and mortar bank. So they may be able to offer more favorable loan terms to the borrower. So next is fast funding. Once approved, online lenders typically reimburse funds quickly, and some lenders can provide access to fund within a few business days. So this allows business to address their financing need promptly. So next is online account management. So borrowers can confidently manage their loans online, accessing their account information, making payments, and monitoring their loan status through the lender online platform. So next is peer-to-peer, P2P. Lenders are online platforms that connect individual or businesses in need of loans with individual investors willing to lend money. So we have 7 how P2P lending works. The first one is the borrower needs fund. And then the second one is the loan application. And third, investor participation. Fourth is the loan funding. 6 is loan approval. 6 repayment, and 7 investment return. So next is vendor credit. Vendor credit, also known as trade credit or supplier credit, refers to financing arrangement in which a supplier allows a customer to purchase goods or services on credit or defer payment for a certain period of time. So it's a common form of short period time financing that help businesses manage their cash flow and working capital need. So the first one, we have purchase goods or services. So they purchase from a vendor or supplier to support its operation. And instead of making immediate payment for the goods or services, the vendor extends credit to the customers. So the next one is payment term. They agree on specific payment terms such as the length of the credit period or any applicable discount for yearly payment. So mostly they include net 30, which means the customer has 30 days to settle the payment, or net 60, which allow for 60 days credit off period. So next is receive goods or services. The vendor delivers a good or provide the agreed upon services to the customer upon placing the order or as agreed in the purchase agreement. So next one, deferral of payment. So the customer is allowed to defer payment for the goods or services for the agreed credit period. So during this time, the customer can utilize the product or services to generate revenue or benefit from their business operation. And the last one is payment settlement. So at the end of the credit period, the customer is required to settle their payment with the vendor. And this can be done through various means such as electronic funds transfer, check, or online payment. So it's a financing arrangement where the business sells its account receivable or outstanding invoices to a third-party company called a factor. So a factor provides immediate cash to the business by purchasing the invoices at the discounted value. So the first one is they issuing invoices. So this a business, they sell goods and services to its customer on credit and issue invoice specifying the payment terms and due dates. So next one is the selling invoice. So instead of waiting to the customer to pay the invoices, the business decided to sell them to the factor. So the factor offers to purchase the invoices at discounted value, typically a percentage of their total face value. So next is immediate cash advance. So once the factor agrees to purchase the invoices, they provide a cash advance to the business, and usually 70% to 90% of the total invoice. So next is collection and payment. So the factor takes over the responsibility of collecting payment from the customer, and the customer are notified to make a payment directly to the factor rather than to the business. So, and then factor fee. So when the customer make the payment, the factor deducts its fee from the collected amount. So this fee is typically like based on the factors such as invoice value and the creditworthiness of the customer and the duration of the outstanding invoice. So next is remaining payment. After deducting the factor's fee, the factor remits the remaining amount called the reserve to the business. And then the reserve is typically paid after the factor collects the full payment from the customer. So next is creative sources of financing or funding. The first one is crowdfunding. Crowdfunding is a method of raising funds through an online platform where individuals or organizations can share their project or idea and collect small contribution from a large number of people. So we have two types of crowdfunding, which is the first one is reward-based crowdfunding, and the second one is equity-based crowdfunding. So reward-based crowdfunding is ideal for creative projects, product launches, and charitable causes, fostering engagement with the audience and generating early support. And however, equity-based crowdfunding offers investment opportunities in startup or small businesses with potential financial returns based on their success. So next, we go to leasing. What is leasing? Leasing is a financial arrangement where one party, called the lessor, allows another party, known as the lessee, to use an asset in exchange for regular payment over a specific period. And leasing provides businesses and individuals with access to asset without the need for large upfront investment or securing traditional financing. So, example of leasing. So imagine you are in need of car. A reliable vehicle to purchase one, but you don't have enough fund. So first we must go to vehicle selection to choose the car that we want, and then we go to the lease agreement with the dealership or the leasing company. So next we go to the payment. Instead of buying the car, you make regular monthly lease payment to the leasing company over the agreed upon lease term. And then vehicle use. You take the position of the car, using it going anywhere you want, and allows you to commute to work, occasional trips, or run errands. So next, you need to maintain an insurance. So you're typically responsible for routine maintenance and insurance coverage for the lease car, and ensuring its proper care and protection. So next is the end of lease, where the end of the lease term, you have the option to return the car to the leasing company, lease a new car, or even purchase the leased car at a predetermined price if a purchase option is available. So next we go to the strategic partners. Strategic partners is a creative sources of financing or funding are trusted collaborators who join forces to secure financial support for creative projects or ventures. So they work together to explore innovative funding opportunities and leverage their combined resources, networks, and expertise to maximize the change of success. So for example, for strategic partners, so let's say you are an owner of a restaurant, you want to open a restaurant, however, you don't have any suitable strategic partners. So the first one you need to do is find a local food supplier to supply the food in your restaurant. So partner with a local farm or food supplier to source fresh, high quality ingredients for your restaurant. So this collaboration not only ensures the quality or the sustainability of your menu, but also supports local businesses and provide a unique selling point. So next is online food delivery platform. As we may know and well aware and well popular that we always use, Foodpanda, GrabFood. So collaborate with a popular online food delivery like that can expand your reach and offer convenient delivery services to your customer. So this partnership can allow you to tap into a larger customer base and leverage the platform technology and logistic expertise. Next is beverage brand. So if you form a partnership with a beverage brand such as a local brewery or specialty coffee roaster to offer exclusive beverage that complement your menu, this collaboration adds uniqueness to your restaurant's offering and promotes cross promotion opportunities. Then the last one is event organizer. So you team up with an event organizer to host a special event such as food festivals or theme dining experience. And this strategic partnership help attract new customer, create buzz, and generate additional revenue through ticket sales or collaboration profits. So so that one is the last one. So this one is the crisis that related to chapter 10, like Dr. Wadi Yudi asked for the last class. This is the two crises that happened in Malaysia regarding the chapter 10 that we have just discussed earlier. So the first one is 1997 to 1998, the Asian financial crisis. So the Asian financial crisis was a major economic crisis that began in Thailand in July 1997 and spread to the other Asian countries, including Malaysia. So the crisis was caused by a number of factors, including excessive borrowing by Asian businesses, their weak financial system, and a lack of transparency in the financial market. So the crisis led to the sharp decline in value of Asian currencies and a decrease in foreign investment and a recession in many Asian countries. So the crisis had a significant impact on the Malaysian economy and many businesses were forced to close or downsize. So the government of the Malaysia also responded to the crisis by introducing a number of measures such as capital controls, a currency peg, and a bailout of the banking system. And this measure helped to stabilize the economy, but the crisis had a long-term impact on the Malaysian economy. So the second one is 2008 global financial crisis. So the crisis was caused by the number of factors, including the collapse of the subprime mortgage market in the US and the failure of major financial institutions and a loss of confidence in the global financial system. So it led to a global recession and many businesses were forced to close or downsize. And the Malaysian economy was not immune to the crisis, but the government of Malaysia was introduced a number of measures to address the crisis, including fiscal stimulus packages and financial assistance to the businesses. And the government measure helped to mitigate the impact of the crisis. And however, the crisis had a long-term impact on the Malaysian economy. So as we can learn from those two crises, those two crises led to the first, increased difficulty in obtaining loan. Second, decreased investment from venture capitalists. And third, increased competition for government grants and loans. Thank you. That's all from me. Thank you.
Okay, thank you very much for your presentation. We have our friends from Malaysia, Miss Hazira, Mr. Ahmad, and Mr. Farhan. Thank you very much for this presentation. Actually, we have many information, about more about finance and about funding and about investment. We are here maybe talking more about entrepreneurship, what the role of entrepreneurship. So to start the business, you have to search for money also, for capital. And this is usually what startups do at the beginning. Maybe before, if we see our friends we have in our class, how many? 25, maybe 23, if I'm not included with Miss Titania, if we are included in class. So please, if you have any question, maybe you can ask our friends who present today. Any questions? Other students? I have to choose someone. Maybe you are you available, all of you, or no?
I have a question.
Okay, who want to ask?
To Farhan.
Okay, Miss Alia. Okay, please, your question.
So why family members and friends are one sources in personal financing? friends and family members.
Oh, okay. So, why family members and friends are one of the sources of personal financing? Because family members and close friends are often have a higher level of trust in each other compared to other people uh, loan or financial institution. This is because when family and friends, you trust them, and of course, family and friends, if you have any hardship or challenges in your life, they will help you. So next is because family members and friends may be more flexible and lenient in terms of repayments schedule or any interest rate or also other collateral requirement compared to financing institution if you borrow from them. So yeah, that's why because more people love to you to lend family members and friends money because of that. Yeah.
Okay, thank you very much. Usually the first people we ask to, if there is crisis or if you want to start business, usually we ask family members. So if there is problem, we are sure they will help us and they will give us support. And if there is benefit also, they can share this benefit. So it is two-side, what you call like two-side solution, yeah. Okay, thank you, Mr. Farhan. And another question? Maybe also you can write your question there if you want to. You can write in chat your questions. Okay, please share the presentation again.
Wait, I saw a question from Atira Izati. Okay, so what is the what's the question again? Wait.
Consequences of family members
Oh,
and friends
okay.
are one of source. I think it is the same question.
Okay,
No?
so the consequences of uh, from borrowing from family members or friends is so they have really unrealistic expectation, such as like you can pay it early or anything. Like family friends maybe have higher expectation or demand regarding the use of the fund or repayment schedule or anything about overall financial management. So that is the major consequences lah of borrowing family members and friends.
Okay, thank you. Okay, I think you share the presentation again. So let's see if other students want to ask any questions. Actually, if we want to talk about the subject from the beginning when presented by Mr. Farhan, I think at the beginning, it is about getting finance. So how to get the finance. We do have many solutions. When you start your business or you are new at market, you need to have money. Yeah, this is with this easy. Usually, for what we need this finance, maybe to start our business, maybe to grow our business. We already started, then we had some problems. We need to increase our operations, or we need to expand, or we need to enter new market. Then we ask again for finance or for money. It is as entrepreneur, it is our what you call our game, how to attract investors, how to present our business and attract investors. And we need this, of course, this money we take even by investors, even by loan, even by family members or any other parties, we use this for as cash flow, because sometimes we need cash for the business. So we use it as cash flow to do daily operation, to cover the expenses, to pay the salaries, to do promotions, to do research. This usually every business at the beginning, they have to spend much money. So it is maybe very rarely to have some businesses directly they have income. Anyone, especially startups, businesses, when they start at the beginning, big business or small business, usually what they do, they have to spend much money at the beginning, and they didn't expect profit maybe in short terms. Maybe if you see, I don't know if you are interested, you see some videos about maybe there is international program named Shark Tank. If you see maybe Shark Tank, this international almost in every country. You see this, they call them shark. They are like shark in business. These people, they give money, they be like what you call investors in your business. Maybe you see the show all around the world. There is Virgin in almost all countries. This is interesting if you are as studying business. Maybe you learn much how they startups maybe do their business, how to start. Maybe you can watch videos about this and learn more. As we said, maybe also Mr. Farhan also give us information why we need the funds. There are many reasons for our need to have these funds. As we said, to cover expenditure, daily expenditure, salaries, marketing, promotion, research, skill businesses, and also for emergency cases. Maybe we have some emergency cases, we need cash, or we need flow cash in our business. Also, the source of personal funds also, or by also Mr. Farhan also discussed this. There are many sources like personal saving. Usually people who has maybe we see some businesses from before, or they have rich family, or they have, I don't know, usually they have money, so they can start their own business. But for some people, especially, we call these people entrepreneurs, because what they don't have this money. Maybe if you see the life of Facebook founder or for Apple founder, you see when they start their life at the beginning, they didn't have anything, so they were looking for investors all the time. Usually this we call entrepreneurs. Why? Because they have something, they have the ideas, then they want to change these ideas to business. They want to start their own businesses. They start work, then they have many investors to help them to grow up until they become maybe from the most famous businesses in all the world. Also, I think Mr. Ahmed also gave us some information about alternatives for the business. Maybe we can see, yes, some alternatives. It is about equity funding, about debit loans, business angels, venture capitals, and as student in economy, you have to understand this. What are the differences between them? Yeah, maybe if you read this presentation again, you will understand. Please, this is important for you to understand, everyone, what are the difference between them. At least you have idea about each items used. For example, when we see equity funding, like you have your own business, then they said, okay, I give you money, you give me equity, maybe 1%, 2%, 10% from your business. This is what we call equity. About debit or loans, usually we take debits from bank, commercial bank, from other maybe people, other organizations, so we can take debit or loans. Venture capitals also, they are limited. These venture capitals usually come to your business, not at the beginning, but when you have already, they understand you have good plans, you have good management, you have good income, you are already stand by yourself. So these ventures also can help you. Also, we have IPO, or initial public offering. This is what some maybe in developing countries usually, even in this, if you see to the international business, maybe for Tesla or for this businesses owned by Elon Musk, you understand there are share always, there are share, and people from all around the world, they can have share from this business. This is what we call IPO, or initial public offering. So we give share to public, and they can buy, or what you call saham, maybe in Bahasa or in Malay you call saham, and anyone can buy. Maybe the price also for every saham is low. It is anyone can buy how many saham for, I don't know, maybe for small price. Source of debit also, as we said, maybe also we can see source of debit. There are banks, commercial banks usually, and also there is SBA, or Small Business Administration. Usually, if you go to bank, you have your own business, you are already famous, known, and strong in market, the bank will give you money. But in case you are at the beginning, you are not the bank will not trust you. When you, especially you start your own business, you have to do what? You have to go to another organization to help you. This other organization, they will guarantee you. They give you guarantee. This is what we call SBA, or Small Business Administration. What we have, you go to them, they believe in this, your project or your startup will work. So what they will do, they will guarantee you there for the bank with how many percent. They will not guarantee you maybe 100%, and also bank take the part from this responsibility, maybe 25%, like our example we said before. 75% maybe could be from the this administration, or separated administration, or what we call SBA. I think also Miss Hazira also give us more examples about online lenders and vendor credits, and what also factoring. Factoring also, it is how to buy invoice or receivable accounts for the business. So we buy your receivable accounts, so we get the money from other people, then we give you cash. You understand? Maybe I need the cash now. You have in your what you call receivable account, you have how much money. We know you have much money in other businesses, so we can collect this. We give you directly cash if you need this cash. What also crowdfunding, creative source. This is maybe more interesting about the creative sources. It is more creative when we use crowdfunding. We can use many people. This is also maybe little bit same as IPO, because initial public offering also the same. Equity based on sometimes this crowdfunding we can use as share or saham. Maybe also we can use them as equity, so they can own equity in the business, or they can use as share. Finally is about leasing, and the leasing, I think when you usually maybe in Malaysia, Indonesia, when you buy something, car or home or this what usually you do. When you buy car, then you go to pay some, maybe what you call this insurance, or I don't know, that some business who do this for you, you have to pay them, or bank, usually even bank pay for you for the car, then you have to pay every month. I think this is an interesting subject. I hope you understand the role also of entrepreneurs, how to focus more, how as entrepreneurs, what you have to do. Maybe you want to start your own business, maybe, or at least when you work later, you understand the needs of small businesses, how to grow up. Also, you have this information. Okay, that's all from our friends Hazira, Ahmed, and Farhan. Thank you very much for your presentation. We come again. Yeah, we come again to the questions. If there is still any question, I think our friends are all sleepy as usual. If we have online class, there is no interaction. Yeah, many of the students they just I don't know if you are still listening for us at least. So please, if you still have any question, maybe you can ask our friends. They are still online and the presentation also still there. If not, maybe I think it is enough. If Miss oh Miss Titania, if you still have anything to add to this class, because you know our students, I usually know, yeah, maybe in Malaysia a little bit different, but here always they are not interested more to ask. So please, if you have any questions, maybe you can ask here.
Yes, for everyone still have question, depends on this material or another, maybe you can ask to Mr. Ansi related to economic also.
Okay. Okay, I think there is no more questions. Yes, our class, I think, will, if we end this class, maybe you will still have online class also, maybe later on with Miss Titania. Yes,
Yes.
okay. Okay, that's all. Yeah, I just came today instead of your lecture. I hope you enjoyed this class. Thank you very much for our friends from Malaysia, Miss Hazira, Mr. Ahmed, and Mr. Farhan. Thank you very much for your presentation. All other students, thank you to have me today. Miss Titania, thank you, and hope to see you maybe another class or your maybe also you meet with next week with your lecture. Thank you very much.
Thank you so much, sir.
Okay, thank you.
Thank you, Doctor.
So much.
Thank you, Doctor.
Thank you, Doctor.
Doctor.
Thank you, Doctor.
Thank you, Doctor.
Thank you, Doctor.